Hi everyone, it's Andrew Wall here. Hopefully going to kick off my screen sharing here in a second so we can get going. Is everyone seeing my screen all right? If I can get a thumbs up in the chat window, that would be awesome. Purpose of today's session is to go through source deduction planning, try and help those of you who've never seen it before, as well as those of you have a bit of experience but aren't too sure what to do with your source deductions. So many of you saw this form that we sent out asking you for a bunch of information about your source deductions. We will come back to this form at the end of this presentation, but let me kick off and show you guys a little slide deck that we prepared to explain exactly what source deductions are. So bear with me a second here. Let me get this slideshow running. So as I said earlier, this deck will be about understanding source deductions. Most of you who know who we are, CPA4IT, we're a multi-generational firm. Originally, Wall & Associates professional corporation founded by my father. CPA4IT is the blend of the two firms coming together. My firm, Wall CPA, my father's firm, Wall & Associates. And now we are under the new designation, CPAs. So CPA4IT is the new brand with the new two firms, which we've got the blend of the knowledge and the experience of my father's expertise over 30 years in practice and my passion for technology and innovation. So hopefully those come together to build an unparalleled firm. As we said earlier, my father's been specializing in this industry for over 30 years, since 1984. We are one of the few ISO 9001 registered firms. We are also a professional organization of chartered professional accountants. I'm not going to go into all the bells and whistles that make us a great firm because most of you are clients. What we're really here to talk about is payroll source deductions. And for those of you who are not familiar with payroll source deductions are the money that are withheld at source by the employer and then remitted to the government on behalf of that employer. So if you were an employee back in the day, you were probably familiar with the fact that if you got paid $100,000, you didn't get $100,000, you got maybe $60,000 or $70,000, and your employer took $30,000 or $40,000 of that off your paycheck directly each month and then remitted that to the government each month. That is what you're doing now as a small business owner. You've got to do the same thing, even if it is for yourself. The only time that this wouldn't be applicable is if you're opting to use dividends versus salary. At the Q&A section, if anyone has questions about the difference between dividend and salary, I'd be happy to go into that. But if you are doing a dividend, then this entire presentation is not applicable. On dividends, there's no tax withheld. It is up to the shareholder to pay the taxes, if any, when they file their personal tax return in April. Now, if you are taking your income in the form of a salary, you must have, the employer must withhold and remit CPP, EI, and income tax. They must withhold that from the employee and remit it. Now, most employees who are related can opt out of EI. And in fact, you would actually opt into EI if you wanted it. By default, you don't have to collect and remit EI for any related parties or any arm's length parties. So EI is not applicable, but the CPP and the income tax is. Now, in addition, employees may have a whole bunch of reasons why they don't have any taxes to pay at the end of the year, maybe big RSP contributions, childcare expenses, who knows what all the deductions you might have personally. So your employer, you're allowed to tell your employer to not withhold tax, and then if you do owe at the end of the year, then you would be required to pay. However, the employer must withhold and remit CPP. If you do not pay that, there are some penalties. We will be talking specifically about what those are later. We'll also be talking about the different types of remitters that there are for source deductions in a minute, because Source deductions get really complicated in the deadlines and the type of remitters that there are. And I'll do my best to explain that in the most simplest terms today. So without further ado, and I apologize, missed a 3, sort of converted it to an 8 there. The big question is, do you need to make a remittance for 2018? And the first question is, if this is your very first year, if you are incorporated this year and you're trying to figure out whether you need to make a remittance for 2018, the first question is, do you have any income from other sources? And if so, how much? Because if you've got income from other sources, imagine you were a full-time employee for the first half of the year or more, then you're going to have income already. And then the question becomes, do we want to increase that income by declaring salary from your corporation? Most situations you probably won't want to, because you'll have the ability, depending upon when your year end is, to defer any money that you've withdrawn from the corporation into the next fiscal year. So if your year end is July or onwards, you have the ability to bonus income from the current fiscal year into the next calendar year. So that expense would still be reported in your current fiscal year inside your corporation, but it would be declared as payable to the employee yourself in the following year. So you can actually bonus out up to 183 days, which is just shy of 6 months. So if your year end is in June, bonusing out 6 months puts you in December, so you'd still have to take any money that you've taken out of your corporation into salary in 2018. But if it's July or onwards, that income could go into the next fiscal year. So that becomes the first question. Do you have income from other sources, or have you already declared income from your corporation? So if your year end is post-July, was your last year, July 2017, did you bonus forward any salary? And then, of course, in both scenarios, you want to know how much, because there are certain basic income levels that it makes sense to take salary up to. Usually it's around the $45,000 mark. The reason I say that is because at about $45,000, the effective tax rate is about 15%, which is around the same as the corporate tax rate. So if you leave the money inside the corporation, you'll pay the same tax as if you were to take it out. So you might as well have a salary of about $45,000. Now, I do say effective tax rate because effective tax is different than marginal tax. I'll give you a brief breakdown of what that difference is for those of you who aren't familiar. Effective tax is you take the taxes that you're paying, you divide them by your income, and that becomes your effective tax rate. Now, marginal tax rate is the tax rate that you pay on the last dollar of income. In Canada, we have a marginal tax system, which means as your income goes into different brackets, the income inside those different brackets is taxed at different tax rates. So when you average all the different tax rates, you get your effective tax rate, but your marginal tax rate is the tax rate on the last dollar of income that you have. So that's the difference between marginal and effective. And I do all of my planning for my clients around effective tax rate rather than marginal tax rate, because marginal is more around short-term planning. Yes, you might pay lower tax in, let's say, anything above $11,000, you'd pay lower marginal tax, leaving it inside your corporation. However, if you so you pay lower marginal tax if you left the money inside your corporation, but higher effective tax. And when we look down the long term, we want to plan around effective tax, because once this year is gone, you can't really go back and get that money out of your corporation. So when you can get money out of your corporation at the effective tax rate that is very similar to the corporation, it is a good strategy to do so. So calculating your remittance amount is, again, it's slightly complicated. You want to look at how much money you've withdrawn since your last corporate year end. This is what we call your director's advance. Now, the director's advance also takes into account the money that you have used to pay for expenses that are deductible for the corporation that were paid for by funds outside of your corporation. So let's say you withdrew $100,000 out of your corporation. But of that $100,000, you took $30,000 and you spent it on expenses that we're going to be able to deduct in the corporation. You're left with a director's advance of about $70,000. And that's the money we want, or that's the number we want to do the tax planning around rather than the $100,000. So the first thing is figuring out how much money you've actually taken out of your corporation, and of that, how much was used for deductible business expenses. You also want to know how much you've actually contributed to RSPs or plan to contribute to RSPs before the deadline, because RSPs reduce your taxable income. So again, this is trying to figure out where your effective tax rate is going to be and looking at the different tax brackets to figure out what will be your ideal targeted net income. So there's some great websites out there, taxtips.ca, if you want to figure out what the different tax rates are. We do have quite a few because there's federal and provincial. So when you look at the harmonized federal and provincial together, we have like, I think something like 9 or 10 different tax brackets. So we do a lot of our planning around tax brackets to figure out what the most effective strategy is going to be. We also want to look at family members to see if we have the ability to do income splitting. Now, prior to this year, we had the ability to do income splitting with shareholders that were over 18. Now, this year, there were some changes to the budget, which does affect the ability to do income splitting through the use of dividends. It does not affect the ability to do income splitting through the use of salary. However, what you need to know about doing income splitting through salary with family members is that it is subject to a reasonableness test, which means, is the salary reasonable for the work that has been completed? Now, with family members and spouses and partners who are your most trusted advisor and your confidant, we've been successful in defending positions where a spouse or a partner makes a salary of about $30,000 just by being your advisor and your confidant and your coach, because they very much are a part of your goal setting, your strategies, your running of the business. We've been able to successfully defend that. As you start to go above that level, there's no black and white. You're not going to find anything that says in the Income Tax Act, this is the exact amount that you can give your spouse. It's going to come down to reasonableness, and reasonableness is a subjective term, and it's also going to be relative to the total income and the total distributions to the company. Now, if you try to do income splitting at 50-50 and your spouse has done very little involved in the business, you might have difficulty defending that. There is also a question as to how much scrutiny salary will go through this year, because obviously a lot of people who were historically doing income splitting through the use of dividends are now going to shift to income splitting through the use of salary. And does that mean there'll be increased scrutiny? I have no idea. Only time will tell. But it doesn't hurt to maybe be a little bit more cautious in years when we're going through transitions. So let's talk a little bit about the different types of remitter types and due dates. This is where it gets a little bit complicated because, as I said, there are several different types of remitter types, and the different remitter types have different remitter due dates. Now, what everyone will notice is that when we do our reminders, we tell everyone to pay by the 10th of January, which is the 10th day following the last month in which you can declare salary for the 2018 year. So the absolute last day that you can declare salary for 2018, obviously December 31st. And the way source deductions work is you have to pay in the month following which you made remittances, and that can either be the 3rd, the 10th, or the 15th. We tell all of our clients to remit by the 10th, even though many of them actually are regular remitters and don't have to remit until the 15th. Very few of you will have a a January 3rd remittance date, but some of you will. I think it's if you're over $50,000 in annual monthly withholding, the average monthly withholdings, which is basically your source deductions amount, then you will have to pay by the 3rd. So those are important things, and we'll talk about those in a second. The other thing to note is that if the deadline falls on a Saturday, Sunday, or public holiday, you do have until the next business day. If your business goes bankrupt or stops ordering, you must remit your source deductions within 7 days following the bankruptcy. Hopefully that's not an issue for anyone on this call. As I said earlier, in order to determine what type of remitter you are, CRA looks at your average monthly withholding amount. And the more complicated part is it's not even from the current year, it's from 2 calendar years ago. So, you have to look back at what your average monthly withholding was actually 2 years ago. As we said, we do tend to encourage people to err on the side of caution and to aim for that January 10th date as opposed to the January 15th date, just to make sure that you buy yourself some extra time. That's also important because sometimes there can be issues being able to transfer over the amounts. The source deduction is probably the largest tax that you will pay as a small business owner, outside of maybe GST, HST. So making sure that you can actually get the funds over by the deadline is important, because if you go through CRA's website, it uses, forget the word I'm looking for right now, but the bank transfer method is effectively limited in most situations to $3,000. If you go through your bank directly, that $3,000 cap is not limited. But you want to make sure that you can be able to make those transfers without hitting the without missing the deadline, because the penalties can be significant. And I'll talk about those in a second. So let me explain the different types of remitters and their due dates. I've touched on this briefly. Looks like we've got some questions. So let me just dive into there. Okay, so now we're having some problems on the audio, it sounds like. So Gordon's asking everyone to mute, and I don't know why my audio is not coming out. Let me, there we go. I had my headphones plugged in. Can everyone hear me all right now? Yeah, you can hear me. Thank you, guys. I appreciate that. So I apologize, just taking a second out to make sure my audio is good. My green screen is not messed up. So let's go back to the different types of remitters and what their deadlines are. So first of all, there's the regular remitter. This is the default remitter type for all new businesses, as well as for anyone who has an average monthly withholding amount of less than $15,000. So this is the most common deadline. It is the 15th of the following month, but we tend to target the 10th as the deadline that we tell everyone, because the threshold one, which is actually from $15,000 to $49.99, becomes a fairly common average monthly withholding amount, because most of our clients are doing an annual bonus or an annual salary. So they typically fall in that $15,000 to $49,000 range. But again, as I said earlier, this is based off of the average monthly withholding amount from 2 years ago. So in many situations, the first 2 years, you're obviously going to be in a regular remitter. And then even after that, it's possible you're still a regular remitter. Now, many people have also got lots of notifications in the mail telling them that they're moving from a regular remitter to a threshold one, or vice versa. You could go from a threshold one back to a regular remitter. If you're getting those notifications, don't worry. It's basically just changing the date that you have to remit by. And they do tell you the date in that form. Now, if it's telling you you're moving to a threshold two, that's a bit bigger of a deal, because that does bring you up to the third. And again, most of our clients that are on threshold two, which is a bit more rare because it's over $50,000 in annual remittances, we're usually well aware of those situations, and we're making sure to tell you of those deadlines. There is also something called a quarterly remitter. So if you have an average monthly withholding amount of less than $3,000, then you're eligible to remit quarterly. Now, this sounds good, but it's not applicable for most of our clients, because most of our clients, as I said earlier, are paying an annual bonus. What that means is, although you were expected to remit source deductions monthly by CRA, if you're paying your employees only once a year, you, while still technically a monthly remitter, are only remitting in the months in which you were declaring a salary, which means you are only remitting once a year. So this is a big misconception, and where sometimes people put their foot in their mouth. And what I would say to you is, if CRA calls you around your source deductions, it is very important to make sure that we're using the right language and literature with CRA, because if we're declaring annual bonuses, you're certainly allowed to do that. But if you're taking monthly amounts out of your corporation and it's the same regular amount, CRA could potentially deem that to be a salary and require you to remit monthly. And then if you haven't, they could charge a penalty on each month. And as we'll talk about in a second, if you've missed that deadline more than once, the penalty can exceed 20%. So it's really important to make sure that we're using the right language and literature. In fact, I'm not necessarily against people doing monthly remittances. It does sometimes help with that planning. The only downside to doing a monthly remittance versus an annual remittance is that the benefit of the annual remittance is we know exactly how much money you've withdrawn from the corporation, so we can help to bring that that tax bracket, that personal tax bracket, as low as possible. And obviously in Ontario here and across all of Canada, the effective or the marginal tax rates personally are substantially higher than the corporate tax rate. So in Ontario, we can go 54.5% personal tax rate versus the 14.5% business tax rate. So anything that we can do to leave as much money inside the corporation as possible, the better off that we will be from a tax perspective. And the reality is that usually the big key factor that is preventing us from going to a lower tax bracket is the actual amount of money that you've withdrawn. So if we do the planning at the beginning of the year, we can over or underestimate that amount, which then means we've got to top everything up, or worst case scenario, we've overestimated and now you put yourself in a higher tax bracket that's necessary. In addition, if you are setting an amount and taking out money and withdrawing it, what I've found for myself and for most of our clients is you tend to spend whatever you set. So if you set a rate at $60,000 a year, you'll spend $60,000 a year. Set a rate at $50,000 a year, you'll spend $50,000 a year. However, if your goal is to spend as little as possible and withdraw only what you need, you tend to spend less. And we've seen that over and over again. Now, the last thing I want to point out about the remitter types and due dates is that associated corporations, so if you have holding companies, if you have other related companies that are other operating companies that are related or associated, then you pay based on the combined average monthly withholding amount. So it's not that each company is judged separately, it's the combined average monthly withholding amounts. So that's an important thing that can trip people up, and move them to a threshold 2 or a threshold 1. So again, this is why we always target that 10th day in case you're actually being pushed into a threshold 1 because of the combined average monthly withholding from the two different types of corporation. So if you are a new remitter, if this is all brand new to you, you must apply for a business number and register for a payroll account number. So if we've done your incorporation, we've obviously set you up with a business number. We will not set up a payroll account number for you when we do that initial incorporation, because it's quite possible in your first year and quite common for many people in their first year, because they have full-time employment salary, that we don't want to declare a salary. And as soon as we register you for a payroll account number, CRA expects you to make remittances, and you'll start getting a whole bunch of letters and you won't know what it is, and you end up spending a bunch more time with us and increasing your accounting fees because you're getting a whole bunch of letters that you don't know and understand. As I said earlier, new employers are all considered regular remitters. So your deadline will be the 15th of the following month in which you declare salary. And as I also said earlier, you can declare salary up to basically 6 months from the date of your year end. We may want to declare some salary in 2018 and make a remittance. If that is the case, then you will need, if you want to go to the bank to make a payment, there's a number of different payment methods. We'll talk about that in a second. But if you want to go to the bank, you actually need the PD7A form, which is the actual specific form sent to you. So if you know that you want to make a payroll remittance in 2018 and this is your first year, you should go and register for your payroll account number now so that you can get those PD7A forms so that you can be able to go to the bank and make those payments if that's the payment method you wish to use. Now, one of the other things that's nice to know is that if you actually make a remittance online or you send a check and you use the payroll account number, they will automatically create a payroll account number for you. Just so you know that the different types of accounts that we have with CRA for small businesses is we have corporate tax, we have GST, HST, and we have payroll. And the corporate tax is your business number followed by RC0001, and your GST is RT RT0001, and your payroll is RP0001. So in addition, if you make a remittance and it goes to the wrong period, it goes to the wrong account, that can be cleared up quite easily, either by yourself or us contacting CRA to get that transferred to the right account. It is also important to note that it is not uncommon for CRA to apply payments to the wrong period. So if you've made a payment and then you get a notification from CRA saying that it's late, or it's or you have a penalty for late filing, give us a call, because it's oftentimes that the remittance and the payment that you've made has been applied to the wrong period. Because what happens to a lot of people is they'll often try and be ahead of the game, and they'll go and make a payment remittance early. So let's say you make a payment remittance on, I don't know, December 27th. And CRA then in early January sends you a notification that you are assessed a penalty. And that's because CRA has applied that, instead of to a December 31st remittance, they've applied that to a November 30th remittance, and now said you're now late for November 30th rather than early for January 10th. Happens all the time, fairly easy to fix with a phone call, and can actually be done on the CRA's website as well. But if you are getting those notifications, that's something to be aware of. Now, to talk a little bit about the different types of remittance methods and the way that you can make payments, is you can do electronic payments online. You can do online either through CRA's website. Now that does, the word I was looking for earlier is Interact. That does go through the Interact network, which for most of you will be limited to $3,000. You can also do it online through your financial institution. Most financial institutions, if you're doing it through their pay your taxes section of the online banking, you don't have that same limitation, but you may have other limitations, so you should make sure that you give yourself ample time to be able to make those transfers in case it has to be staggered over several days. It's also important to know that if you are making an online payment, that online payment must be made a minimum of 24 hours before the deadline in order for that to be deemed to be on time. So the other way that you can make the payment is you can make that payment at your financial institution on the day of the deadline. However, in order to make that payment at your financial institution, you will need that PD7A form that is mailed to you from CRA. And this is not something that we can print or reproduce or download for you. It will be sent to you, not to us, to you. And if you don't have it, there's unfortunately not much that we can do for it. Apparently you can do it through your ATM too. I've never done it through my ATM. You can also do it through the mail. You can even drop the checks off at CRA offices, although CRA does not stamp them and won't guarantee that it's deemed paid on the date that you dropped it off. So we're not a big fan of that method. You can also make payment arrangements with CRA if for whatever reason you're behind or unable to make your entire remittance. We do strongly encourage you to contact CRA and make a payment arrangement with them. Sometimes they may or may not waive the interest and the penalties, but at least they will not send you through to their collections department and start hounding you. So if you can't make your entire remittance for any reason, we strongly encourage you to reach out and connect with CRA. So the CRA remittance form, I've sort of beat this one to death here. As I said earlier, it's called the PD7A. It is specific to your business. We can't reproduce it. We can't print it for you. I know I've said this now 3 times in this presentation, but we get this over and over again. When you complete your remittance voucher or complete the online payment, there's a couple of key pieces of information that you need to complete on those forms, whether it's the online form or the PD7A. They're going to ask you a couple of key pieces of information. First of all, what is the gross payroll? This is the total salary that's being declared, including the source deductions and CPP and all that. So this is if you were paid $100,000 a year salary, this is that $100,000 number. They're also going to want to know the number of employees. So if you're doing income splitting with your spouse or your children, let's say you did 100 for you and 40 for your wife. The total remittance amount would be 140, and the number of employees would be 2. And then the last question that they're going to ask you is, what is the remittance that you are making? That is the key pieces of information that you need to place on either of those forms, whether you're using the PD7A or you're using the online remittance voucher. If you are not making a remittance because you don't have any source deductions to remit, you're not declaring any salary for any employees during this period, it's important to notify CRA. That can be done online, over the phone, or by mail. When you get that PD7A, there's a part on that where you can say, I have no employees with any eligible remittances. I don't expect to have any eligible remittances until such and such a date. What will happen to you, probably, assuming you make a payment in January, probably in maybe late February, early March, you're going to get a notification saying, why haven't you made a remittance in February? You just made one in January. Why haven't you made one in February? And this is because CRA is looking at the typical type of business where they have standard employees that they're remitting and paying every single month. So they don't understand why you paid this month and not the next month. That is easily solved by either completing the PD7A that they will send you and telling them that you have no employees with any eligible remittances, contacting CRA, which CRA is doing their best to eliminate your ability to do that. They certainly prefer you to do that online. You can also do that through your online My Business account with CRA. And of course, if you're having any troubles, contact us and we'll be happy to help complete that for you. If for any reason you make a remitting error, you have under-remitted, you have over-remitted, the payments have been misapplied, these can be easily solved. As I mentioned earlier, misapplied payments are typically solved with a quick phone call, or can be done through CRA's online account to just have them transferred to the correct account. The good news is that when CRA transfers it, they'll consider the date of payment to be the original date of payment, not the date of transfer, not the date you realized it was applied to the wrong account or the wrong period. So that's great about the misapplied payments. Now, on under remittances or over remittances, this is where it can get a little bit more complicated. If you're trying to get a refund on your source deductions, it can take a lot of time and create a lot of unnecessary attention. The simplest and easiest way to correct an under or over remittances is through the T4. So what happens is, when you make a remittance, you're telling CRA that this is the number of employees, this is the total payroll, but you're not actually breaking it down between how much is for each employee and how much is for CPP and how much is for tax and how much is for EI. That's done through your T4. So typically what we do is, when we create the T4s, the T4 will match exactly to the remittance amount that you have made. Now, if you have under-remitted or you have over-remitted, what that will mean is when you file your tax return in April and you enter in the numbers that are on your T4, the tax software that you use or the accountant that you use will calculate what the tax payable is on the gross income that you have, and then they will subtract from that tax payable the taxes that have been withheld at source and remitted to the government, which is identified by the numbers that are on your T4. So if the employer has withheld and under remitted, then you will owe more taxes in April. If you have over remitted and over withheld, then you will get money back in April. It's very, very difficult to get the exact remittance amount correct because there are so many other factors that go into your personal tax return. Do you have a spouse? Are there child care benefits? Do you have RSPs? Do you have other income? So many factors that go into calculating your personal tax return that your employers may not have on hand when they're doing your source deduction calculation. So if you've under-remitted or over-remitted, that's typically how we correct that. Now, as I said earlier, the employers are allowed to not withhold tax, but they are not allowed to not withhold CPP. So if you've under-remitted, but the under-remittance is still sufficient to cover all of the CPP, you won't be charged a penalty. Now, if you have under-remitted, so much so that you haven't even remitted enough to cover the CPP, CRA will charge you a penalty on that under a remittance amount based on the T4. Now, failure to deduct penalties. These are significant, probably the largest tax penalty that you will see with CRA. If you are 1 minute late with your source deduction remittance, there will be an automatic 10% penalty. And there's nothing we can do to waive that or ask for leniency. It is what it is. CRA takes this very seriously because this is money being withheld from an employee by the employer. So if the employer is taking that money, they're holding that in trust, and if they don't remit it to the government, they're effectively defrauding the government and that taxpayer. So the penalties are quite significant. Also, if you fail to deduct the required amount more than once in a calendar year, CRA may apply a 20% penalty. And this again comes down to that section where we see this over and over again is people get those letters from CRA saying, hey, how come you haven't made a remittance? And they don't respond to them or contact and deal with CRA, and then CRA does an arbitrary assessment and then hits you up with big penalties, can cause you unnecessary headaches. So if you are getting any sort of notification from CRA, make sure that you are dealing with that. I know many of you are detailed type A, well-organized people who would never let that happen. We do see it time and time again, clients who let those brown envelopes pile up. Maybe they're intimidated, overwhelmed, don't understand what it means. If you get those, deal with them. If you don't know how to deal with them, contact us so that we can help you to deal with them. That's it for the core of my presentation. I do want to do a couple things now. I'm going to open it up to Q&A. I'm also going to take you over to the form that we have sent each and every one of you. I'm going to walk you through how to complete that and why it's important for you to complete that. Okay. So if anyone does have any questions, feel free to either post them in the chat or unmute yourself and ask. And I am going to do my best to get over to the form that we have. Bear with me a second here. So here is our form. We do try to put a detailed description of what we're looking for here. We have your company name, your email. These are really critical fields here. Do you want us to prepare T4s for you? Do you want us to prepare T5s for you? So even if you're not calculating source deductions, you're taking dividends as opposed to salary, please make sure to tell us no, you don't want us to prepare the T4, and yes, you do want us to prepare the T5. If you're calculating this and you fill in the other forms, please make sure you tell us you want us to prepare the T4, because otherwise we won't prepare it for you. You need to notify us that you want us to prepare the T4 in order for us to prepare the T4. Just because we do the tax planning for you right now, we don't make the assumption that that means you want us to prepare the T4. Some of our clients do prepare their own T4s. If you've got the knowledge, that's fine. I just caution you to be careful of that, particularly if you've got a home loan or an auto loan, because there are taxable benefits that need to be calculated on that. But if you're comfortable and you want to do it yourself, that's fine, but just make sure you let us know. Otherwise, we'll keep hounding you until you do tell us. As I said earlier, one of the most important questions is how much money did you take out of that company? So in order to get to that, we ask you a couple of core questions. How much money did your business earn? How much money did you spend personally on business-related expenses? How much money did you take out of your business? The point of these questions is to try and help us figure out what your net director's advances are, and how much money has your company already paid towards 2018 payroll taxes, and did you take money out of your company for the purchase of a home or a car or loan? So one of the things that you can do in the year that you purchase a home or a car is you can do auto loans. So if you might have taken out $500,000 out of your business, but $450,000 of it was for the purchase of a new house. So there might be reasons that we don't want to declare the entire $500,000 as salary for you. So the more information that you can give us, the better off that we will, the more accurate tax planning that we will be able to do for you. Now, we have really pared this down from the Excel spreadsheet that we used to do. We're really trying to get it just down to the key questions. We love feedback. If it's still complicated and overwhelming, give us your feedback. We're always striving for constant, never-ending improvement. We need feedback from you guys that this was complicated, I didn't understand it, this was easy to follow, whatever the case might be. Give us that feedback so that we can make the process better for you and for other clients. Of course, we're going to need your name, your date of birth, your social insurance number, your RSP contribution limit if you've got it for 2018, as well as any RSP contributions you have already made or are planning to make. Obviously, you've got till the end of February to make an RSP contribution, so just let us know if you do plan to make any RSP contributions. Other personal income from outside the corporation. Again, this is helping us to figure out where the ideal tax bracket is going to be for you. So we need to know how much income that you've got from other sources. Because if you've taken no money out of the corporation, we might say, hey, we think you should declare a salary. But if you've taken no money out of the corporation and have a big pension, which is the reason you've taken no money out of the corporation, then we probably don't want to declare a salary for you. And of course, any other personal deductions that you might have. So the flip side of that, do you have other income, which would drive your net income personally up? Do you have other deductions that we should be aware of that would drive that down? Any notes or comments that you think would be applicable? And then details related to your spouse and your family. Again, trying to help us pinpoint whether we want to do any income splitting. The last thing that we do ask is sole proprietorship details. The reason that we ask this is because if you have a sole proprietorship or you had a sole proprietorship prior to incorporating, that helps us to pinpoint areas where we don't want to increase your salary because we've got a whole bunch of income personally from the sole proprietorship. In addition, if it's a sole proprietorship, you might be doing salary for other people and issuing T4s. Because you can do income splitting in sole proprietorships as well. We need to know that information. And that's basically the details of the form. Now, what we will tell you is if you do not complete this form, we are going to hassle and harass you until you complete this form. If you don't want to do any tax planning, just complete the form with everything being blank and just tell us, no, I don't want you to do a T4. No, I don't want you to do it. There is also another button in the email that you receive that says basically, I'm going to do it myself. Don't bother sending me this. Let me see if I can try and show you what those emails look like. So this is our year-end reminder sequence. So these are all the emails you will get if you do not opt in. We use a tool called Infusionsoft, which the minute you click one of these links will pop you out of this reminder sequence. But if you don't click on these links, you don't complete that form, we will harass you until you do. Now, it looks like we took out of this year's process I'm doing it myself. Let me just double check. Oh, no, we've got that. The first one was just the general reminder. So I'm doing the tax planning on my own, or I've already done it. So if you click either of those links, that will also stop your reminder. So if you click basically any one of these links, it will stop the reminders. Of course, you can also complete the tax planning calculation, and that will stop the reminders and trigger a whole series of reminders for your account manager to follow up with you. I do also ask for a bit of patience in getting a response from your account manager. We literally get 400 or 500 tax planning requests at this time of year. So we, as your account managers, are inundated. We're doing our best to make sure that we're getting back to you. I promise we will get back to everyone who submits one of these forms. It will also be done on a first-come, first-served basis. So complete your forms as early as possible so that we can get back to you as early as possible so that we're not pushing it right up to the deadline. We will get back to absolutely everybody before the January 10th deadline. So like I said, the earlier you get that done, the better off we'll be, and the more realistic it will be that we'll get back to you as quickly as possible. So that's it for my presentation. I'm just wondering, does anyone have any questions that they would like to ask? Does everyone feel like I've answered their questions about payroll and source deductions? What can I do to help you guys? No? That means one of two things. I've either done an amazing job or I've done a really bad job. Hopefully I've done a really good job and I've been able to break this down for you guys in a way that's simple and easy to understand. We will be sharing, oh, there's a question in the chat. Sorry, guys. Can you compare and contrast T4 and T5? Great question. So a T4 is issued for someone that is taking a salary, and a T5 is issued for someone that is receiving a dividend. So T5 is dividends, T4 is salary. Now, I might even take a minute to explain the difference between a salary and a dividend. They are both effective strategies depending on what you're doing. Typically, we do recommend during your income earning years that you make use of salary over dividend. Now let me explain what the difference is and why we recommend one over the other. So a salary is income to an employee, and as such, it's deductible to the corporation, and the corporation doesn't pay corporate tax on that. Sorry, guys. And so the corporation doesn't pay tax on that. As a result, the employee pays the full personal tax rate, the full effective tax rate on that. Now, in addition, the employer must pay, and both the employee and the employer pay CPP on that. Now, CPP is not a tax, it is a pension. We're big fans of CPP because as independent contractors, it's typically the only form of pension that you'll have. And while it's not probably enough to live on its own, it does guarantee some subsistence in retirement. So we think it's a good thing. Now, the other thing that's going to happen when you take a salary is every dollar that you receive as a salary gives you 18% room, or 18 cents for each dollar up to the maximum of room that you can contribute to RSPs. So RSPs are a very effective tax strategy. If people aren't familiar with those, let me know. I know we've got a couple other questions. I'll get to those in a second. So with a salary, you get CPP and you get RSPs. Now, a dividend does not build up any room for RSPs, and as well, you don't withhold and remit CPP. You don't withhold and remit anything, as I said earlier. So some people think CPP is a waste of time and money and they don't want to contribute. So then a dividend is an effective strategy there. In addition, because a dividend is not a deduction to the corporation, it's not an expense, what that means is that the person receiving the dividend gets a tax credit. It's a complicated formula. The long and the short of it is they're trying to give you credit personally for the taxes that the corporation has already paid on that dividend. If you look at the effective tax combining the tax, corporate tax, and personal tax on a dividend, it is the same as the personal tax on a salary. Now, they did an integration a few years ago to make that as close to equal as possible. I think if you play around with the numbers, you can get up to a maximum of a $500 difference between the two, but effectively it's the exact same. The difference is the CPP and the RSP. Now, where a dividend would come into play during your income earning years is if you have a loss in your corporation. So we don't want to further a loss by giving you a salary and creating another expense that will further a loss, especially if you can't use that loss and carry it backwards. If you can use that loss and apply it backwards and get a refund, which you can do for up to 3 years, we might still consider a salary. But after that, we might go, okay, let's maybe do a dividend, let's do a split. I don't typically like splits because you're not getting the benefits, the entire benefits of one strategy. You're sort of meddling the two, and you don't end up with the full benefits. I say you're in for a penny, you're in for a pound. Typically, I'll say go either full salary or go full dividend, so you're committed to whatever the strategy is that you want. However, in those situations where you have losses, we might use a combination just to try and optimize the right amount. And your account manager will really work through that with you. So hopefully that's a good explanation of the differences. Now I got some more chats in here. And let me scroll up here because there's actually a couple. Let me see where I left off. Contrast T4. Does the person taking a salary need to be a shareholder? No, the person taking a salary does not need to be a shareholder. The other thing to know and understand, as I said earlier, with the new budget, you basically can't do dividends, even if they are a shareholder, to people 18 to 24 years old, unless they're working full-time in the business. From 25 to 65, there's this gray area where it's subject to reasonableness, and we don't know what or how CRA is going to interpret that. And then from 65 and up, you can do dividends again. But that's big changes that happened this year. So Greg also was asking about sole proprietorship. He was a sole prop until mid-2017, and we're in that tax in April of 18. I'm not remitting. I'm assuming now remitting your first corporation tax. Do I still note my sole prop on this form? No, if you've had no sole prop income in the 2018 calendar year, you don't need to note that. It's again, like I say, more for planning if you do have sole prop income in 2018. We don't want to declare a bunch of salary for you if you've got sole prop income. Join late. Hope I get a copy of the presentation. Yeah, we're recording it, so this will be saved and uploaded to YouTube. We had hoped to go live, but on Facebook, but we had some problems there. If no salary will be paid in 2018, then no T4 is required for 2018. That is absolutely correct. But what is important, again, going back to that PD7A, is making sure that you notify CRA that you don't have any employees with any eligible remittances during this remitting period, so that they don't come and hound you, particularly if you paid in the past. If this is your very first year and you're not planning to make any remittances, you don't need to do anything because you're not on the radar yet. Yeah, I assume that's what. So Greg's just clarifying his question that he was remitting. I'm glad it was helpful, Greg. I think. I think that's it. There's no other questions. I'll dial out now. Thanks everyone for joining us. We will make the slide deck, PowerPoint, and the actual recorded session available for download for those of you who came in late. And that's it. So thank you everyone for dialing in, and enjoy the rest of your Tuesday. Bye for now.